So the Bank of Canada raised interest rates again, 50 basis points to 4.25%. Yesterday, the financial media has gone wild, thinking that a soft landing is coming, saying that the banks are all fine and everything's absolutely great. And I'm going to show you one of the biggest banks in Canada, a massive, massive hole in their balance sheet, which they just do not have filled. So anyway, let's get right into this. Bank of Canada hikes benchmark rate by another 50 basis points. Okay. So another interesting thing that came into the financial media was this, that last time Canada's yield curve inversion was this steep was just before the early 1990s recession. I said that literally a couple of weeks ago, and I've been saying about the yield curve inversion for over 6 months now. This is a huge, huge deal because the predictability of the yield curve is there. You can see it in the chart. And it's very, very important to pay attention to what's going on there. And if you look at the chart, so I can show you what's going on, you can see that way back here during the late 1980s, the yield curve was inverted. The green line was above the red line. So essentially you got more of a yield on a shorter date treasury, like a 2-year government bond, which is essentially loaning your money out to the government for 2 years than you did for 10 years. It doesn't make sense, does it? And that is the point. It's not meant to make sense. It only makes sense when you have a massive crisis that is coming, and every time this is inverted, there's been some form of a crisis. I mean, if you look right here, this was the dot-com bubble crash in 2000. Then again, it gets very close and inverts ever so slightly in 2007. And then right now, the inversion is absolutely huge. And if you look at 2019, again, you had the same thing. The yield curve inverted in 2019. It wasn't necessarily telling you that, hey, there was going to be a massive pandemic. It was just telling you that the banking system, there was problems that people did not know about. This is our insider window into the financial system so that we know whether things are bad or things are good. And I believe this is so incredibly important. And this really shows you how stupid things have got right now since the Bank of Canada hiked, how the bond market isn't listening to the Bank of Canada whatsoever. They don't care. So let's take a look at this. So the Canadian 2-year bond is at 3.85%. That is 50 basis points less than the Bank of Canada's overnight lending rate, where chartered banks can essentially park money at the Bank of Canada and earn that rate totally risk-free. Totally risk-free. It's backed up by the Bank of Canada's money printing machine. But it's gone up 6 basis points. And if you look down here, the 30-year has barely even moved, 2.8%. That is just unprecedented. I mean, you just can't understand. That's like 1.4% of yield curve inversion between the overnight rate and the 30-year. And a lot of people are going to be wondering, well, what does that mean? It doesn't mean good. It means extremely bad what is going on. And it's only going to become evident later down the road. You know, the Bank of Canada, right or wrongly, has been hiking interest rates, and they continue to do that. But the thing is, what consequences is that going to have later down the road? Now, inflation is obviously running very high, and they are going to kill demand to a certain degree, because what a lot of people forget, I see a lot of comments kind of tripping up on this a lot, is yes, interest rates compared to back in the 90s and the 80s are a lot lower, and you saw way higher interest rates back then. But the difference is the amount of debt that households and corporations are holding on their balance sheet, and even the government. The government is absolutely up to their debt in eyeballs because of the pandemic. So there is major differences compared to back then, which means that you need less interest rate hikes to put the pressure onto the economy. And the thing is, the bank, in my opinion, the Bank of Canada has already popped that bubble. The bubble has already exploded. And now they're just like waving the pin around, looking to pop even more bubbles. But again, it's just going to mean more pain is ahead for people. And if you don't believe me, look at this, because this is history of failures of financial institutions in Canada. And you can see between 1987 and 1996 that half of all the banks and financial institutions that went bust in Canada happened during that period. Now, I'm not saying to you that financial institutions are going to go bust, go get all your money out and everything like that. That's not what I'm trying to say. Go and do a bank run. I do think it's important to have some form of insurance on your money and against government stupidity, though, because at the end of the day, these banks are backed up by the money printing and credit printing presses of the Bank of Canada and the government. So yes, they're not going to let these financial institutions fail. They can't, because the currency would just be worthless. The currency would go down a lot even if they fire up that money printer and have that response anyway. But I think it's important to recognize that the financial institutions are propped up by a money printer, and it's propped up by this institution called CDIC, a lot of the deposits. And I'd urge you to go and make sure that your deposits are actually covered by that scheme, because a lot of people ask me about that all the time. Just go to their website and check it out. And again, the stupidity just continues here. Housing downturn, no match for Canada's resilient banks. You know what? You can use this as a good indicator in a way of how the banks are in trouble, because every time near enough the financial media starts peddling this kind of garbage, that is an indicator that the opposite is true. It's also like Jim Cramer. You can essentially just make money by selling when he says buy and by buying when he says sell, because everything does the complete opposite of what he says. And this is probably going to be the same thing. Same is true of this. Housing downturn, no match for Canada's resilient banks. Okay, let's take a look at that. So I want to take you over to CIBC, which is one of the biggest banks in Canada. They're way have huge exposure to the mortgage industry and to mortgages and debt, essentially. Household debt, business debt, corporate debt, all those type of things. CIBC has massive exposure to that and kind of has a lack of diversification, in my opinion. When you look at their loans, I mean, it's just unbelievable for starters. But this chart tells you more of a story. And since I took out this trial, I've been going over the banks, and I'm probably going to be doing more videos about it as I find more and more just kind of alarming things about their balance sheet and cash flow. So anyway, if you look at this chart here, you can see that they have 520 billion with a B in outstanding loans. So that is just an insane amount. And you can see how this has pretty much just gone up. And really, you can see how this just absolutely accelerated during that 2008. After 2008, that is how Canada got out. They just accelerated the growth of the debt bubble. Just a disaster. It's going to have disastrous consequences. And, you know, there's been all levels of government. You've had all different types of governments. You've had conservative governments. You've had liberal governments. You've had liberal and NDP governments. And they all, I mean, the NDP, Jagmeet Singh keeps coming out and saying, hey, how about the Bank of Canada stops raising rates? But I thought you cared about inflation, which affects the poorest members of society. And I'm not saying that their rate hikes actually does bring down inflation. I'm just taking their thought perspective and thinking it through from their perspective, because they believe that the Bank of Canada's rate hikes will bring down inflation. So why is he then saying, hey, it's time to pause, stop hiking, when he is meant to be representing the poorest people that in society, which he clearly isn't doing that. It's just hilarious. And you know, it's happened through all governments. So the thing is, which I want to tell you, is no change in government here is going to make any sort of difference. I mean, I hear conservatives saying, oh yeah, the Bank of Canada has that 2% target for a reason. 2% inflating the bubble. How about the target is 0%? Nothing. I think if you go survey everybody, they're probably going to say they would rather have 0% inflation rather than 2% inflation. But nobody ever asks the question of why is that? It's because the central bank has to continue to inflate, constantly inflating this bubble, and it's just kind of crazy. So anyway, looking at the amount of loans they have, and if you look at the loan loss provisions that they have, they actually upped their loan loss provisions. And you're just going to laugh your head off at this, because I just laugh my head off at it. When you really dig into their balance sheet, it just makes you laugh. The bank, however, saw provisions for credit losses surge to 436 million, which sounds like a big number when you don't quote the amount of loans that they have outstanding. $520 billion worth of loans. Where's that? They don't even say that in this article. This is the financial media. This is what they do. So the provisions for credit losses surged to 436 million for the quarter, up 358 million or 459% from the same period last year. So everything's great, guys. Everything's great at CIBC. Oh my God, everything is fantastic there. Their loan loss provisions are up 459%, $436 million. Yeah, but you're missing the point. They have $520 billion worth of loans outstanding. Do you know how much that is a percentage of their loan portfolio? 0.08% they have in loan loss provisions. So, I mean, that means if they have to write off 2% of their loans, 2%, they're bankrupt. They're bankrupt. It's just absolutely hilarious. I cannot believe this stuff is even allowed to hit the press, because this is your misinformation. I mean, it's just, and you have to laugh, because if you don't laugh, what would you do? You just get angry, frustrated, which is no good for your health. So it's just so funny. So this is where it shows you basically where rates have gone, and you can clearly see that the lower highs and the lower lows that we've seen over the past 40 years are over. We've got now newer highs. So this thing, it could be going higher. It's probably not. They're probably going to take a pause soon, I would think, even though they're not even getting rates above the rate of inflation. Food prices are still exploding. Still many different things that are going on. So I find it absolutely crazy when you really think about what's going on. It's kind of crazy. So I don't know. It's going to be mad. We'll have to see what happens with this and continue to monitor it. So we got a super chat here in the pocket. Thanks for the show. Real estate prices here in Vancouver haven't gone down much still. Next winter bottom. Yeah, I mean, I don't know when the bottom is. It's very, very difficult to call that. And thank you so much for the super chat. I mean, Vancouver prices last time I checked were down, but even if they're not, I've seen that sales are down over 60% in Vancouver. So that means the market is incredibly illiquid. And this is what you've got to remember. Even if prices stay flat, which they will do because we're in that sort of denial phase and nobody is being forced to sell right now. But as soon as people start to lose their job and they are forced to sell, that's when you really see capitulation in the housing market. That's when you really see that denial effect that people had almost flips on people, because then they're like, holy, we have to get to market. Prices are dropping really fast right now. You get these impulse sales. And once that happens, there's really nothing the central bank or the government can really do about that. It's too late. And we're already pretty much at that point because they've dried up the market and made it so illiquid. So I hope that kind of sheds some light on there, but it's very hard to tell where the bottom is. I mean, I think that real estate prices in real inflation adjusted terms are going to be falling for decades in Canada, because quite frankly, Canada is in such a bad position created by just 20, 30 years worth of reckless government spending and monetary policy and greed and so many different things, that you have to pay the piper for that, and it's not going to be over in 1 year. And even if you have like a massive crash and then prices just flatten out, what is that in real terms, adjusted for inflation? Are they actually going down? And I think that's likely what we'll see. Exactly like what's happened in the UK, actually. You look at the UK housing market, real adjusted for inflation prices are deeply negative in the housing market. So, and the media is saying prices are up like 5%. Yeah, whatever, go with it. Anyway, thank you so much for the super chat and thanks for supporting the channel. Anyway, thank you so much for watching. You might like this video here. You might also like this video there. And I will see you guys in Mexico next time. I got a video that's coming out on Sunday on Alberta. You're gonna really like that video, I think. So make sure to check that out and I'll be on the premiere for that. So I'll see you on the next one, guys. Have a